ISM manufacturing down to 54. That's the lowest level in about 2 years. The new orders component down to 51.1, a drop off from the prior period, which was 62.1. Are you concerned about these kind of numbers?
I am, and think of the global growth story. And it's interesting that in your Apple discussion, you said it's both a micro and a macro issue. Global growth used to be about synchronized pickup. That's where we were 12 months ago. Then we went into divergence with the US outpacing Europe and China. Now there's evidence of the wrong type of convergence, that the convergence is happening with the US slowing to where the rest of the world is. And that is why the market reacted to the ISM number. The bond market has sensed this, because if you look at the 10-year differential between US Treasuries and bonds, that's now below 250 basis points. So the concern out there is that we're getting the wrong type of convergence in global growth.
The market had already sniffed this out, Mohamed. I mean, global growth, slowing US growth, that was the story of the last 3 months of 2018. So are we getting numbers that make it appear worse? Where are we relative to expectations on how much the US is slowing?
So in the last 3 months, the view has been the rest of the world is slowing, particularly Europe and China, but the US has enough momentum. Now, there's two types of concern. One is that the policymakers aren't sensitive enough to the spillbacks, to the possibility that we get contaminated from what's happening abroad. And the second concern is that market volatility could feed back into economic weakness. So it is different. This is a different type of concern than it has been earlier. And it speaks to how do you regain the momentum? How does the Fed regain control of its narrative? And that's going to be really important over the next 24 hours as we both get the jobs report and as Chairman Powell gets to speak tomorrow.
Are you reading anything into the weekly jobs numbers that we got in, the increase from the ADP jobs, and the increase over what was expected in terms of jobless claims?
Yeah, they confirm that the labor market remains solid and that we continue to create lots of jobs and that wage growth will continue to rise. The problem is that those are lagging indicators. And that's why the market responded so quickly to the ISM number, because the market thinks of the ISM number as being more of a leading indicator. And that leading indicator came in rather weak. So yes, we are going to get confirmation of a strong labor market, but people now have moved on and are worried about, well, what next?
Well, one thing that conceivably, Mohamed, could change momentum would be a trade deal with China. I'm not going to ask you to give me your opinion on it, because nobody really knows. But if, in fact, we did reach a deal with China, would it have a positive impact, do you think, overall on sentiment and conceivably start to turn the global economy back?
At the margin, yes, David. And I've been consistently saying we will get a good deal with China, because China has no other options than to do what Mexico, Korea, Canada, the EU do, which is provide concessions to the US, because the US wins a trade war. The issue is that that is not the main concern out there. The main concern is that there aren't enough pro-growth policies, certainly not enough in Europe. And in the US, we're not seeing much come out on infrastructure, which is really important. So yes, it would help at the margin. I think the first thing to change to the positive, if you think of the three things that are undermining markets: fundamentals, liquidity, and technicals. The first thing that will change to the positive are technicals, market psychology. If you're looking for something to look at on high-frequency basis, follow what's happening on market technicals. And the fact that we had very differentiated performance earlier this morning was actually quite encouraging.
Yeah, although it's not getting much differentiation now as we sort of continue to weaken after we did get that number from Rick at the top of the hour.
Very weak manufacturing.
Yeah.
Yeah, because that ISM number, correct, because that ISM number confirmed, yeah, and that's because the ISM number confirmed the fundamental weakness.
So, Mohamed, chances of a U.S. recession in 2019 right now?
Small, unless we get a huge policy mistake. don't underestimate the momentum still in this economy. So we only fall into recession through a massive policy mistake.
Many people think we've already seen that from the Federal Reserve.
Nothing that can't be corrected. What we've seen is miscommunication, and miscommunications on 2 points. One, insufficient openness to spillbacks from the rest of the world, from market technicals, and two, this notion that a very important policy tool, balance sheet reduction, is on automatic pilot. The market doesn't want to hear that. The market wants to hear that the Fed is open to using all its tools to fulfill its objectives. And I think Chair Powell has the possibility tomorrow to start changing the narrative. But it's not going to be instantaneous. It's going to be a process.
Right. So do you think it's been underestimated, the impact that the balance sheet reduction has had overall?
Yes, just as it was underestimated the effect that QE would have. I remember when we started QE2, QE2.5, QE3, people underestimated the impact on financial assets. And I think now there's been an underestimation of what QT does to markets.
Do you think the Fed realizes that? It doesn't sound like they do.
I think it's going to take time. I think Robert Kaplan's comments are important in saying, yes, we should be open-minded about this notion of automatic pilot. So it's going to take time, just as it took time the other way around, Sarah.
You know, Mohamed, yesterday Sarah and I were talking about perhaps a renewed focus on balance sheets of corporate America in terms of leverage ratios and the like. Do you think there's going to be an increased focus, though, on the balance sheet of America itself, given the deficits we're running at this point into next year?
I'm not worried about America itself in terms of the government debt. I think that's manageable. But do look at the corporate sector. High yield issuance has stopped completely. And you have firms that have high cash burns, little liquidity, and refinancing needs. So you're going to start seeing a pickup in the default rate in the high yield complex. And that's an issue to keep an eye on.
So given all these factors you're talking about, do you think we're in a bear market? And would you tell people to buy stocks in this kind of environment?
So I would tell people to be very selective. And this is actually an opportunity for active management to finally show us whether they can produce alpha or not. Second, don't underestimate the value of cash. It is difficult to hedge in these markets if you're not a very sophisticated investor. And cash gives you not just resilience, but agility to pick up what is the third point, which is you're going to get massive overshoots. You already see some overshoots in companies that are very solid, and yet have been beaten up excessively. So I tell people, be very selective and just make sure that you can afford your mistakes, because this is a market that's going to surprise you, especially with the fact that it has overpromised liquidity with the proliferation of ETFs and passive investment.
And here I thought you were going to tell people to buy the yen. I know that 3% move overnight got your attention.
It did, and it shows you that liquidity is an issue.
Yes.
The system doesn't have as much liquidity as it has promised to its end users.